Welcome back. We are now in exercise 8 and this exercise is based on chapter 10, that's on ratio analysis. So in the chapter on ratio analysis we have discussed various ratios. We also discussed that none of these ratios we do manual calculation because all banks have the standard formats in Excel, right? So we'll be feeding the CMA data into the Excel template and the software will be giving you the ratios automatically. So you will not be doing any manual calculations. But in spite of that, let us do some manual calculations in this exercise so that this will give you a feel of ratio analysis. Okay. So again, I repeat that whatever we are going to do in this exercise, you're not going to actually do it in your banking practice, right? This is done by the software, but to understand the concepts better, let us do the calculations manually. And in the process, you'll also be understanding what is exactly happening in the background, right? Sometimes if you depend too much on the software to give you the results, say for example, you find the current ratio last year was so and so and this year was so and so. So you find an improvement, right? Why it has improved is something which you will not understand unless you do these manual calculations. You need to do a bit of digging, right? Unless you investigate a bit further, you're not going to understand the true picture. So in this exercise, we'll be doing these calculations manually, and in the process, we'll be learning what's actually happening in the background. Okay. So this example will be focusing on CMA data of a dummy company, right? This is dummy data. This is data for the last this example has got data for the last 3 years actuals, right? So we have the audited financials of the last 3 years, 11, 12 and 13, and then the projections for the next 3 years, that is 14, 15, 16. Okay, 3 years. So 3 years actuals and 3 years projections, right? This is the based on audited balance sheets, and these are the estimates projections given by the company, right, for the next 3 years. So 2013 is the latest available balance sheet. 2011, 12 and 13, and 14, 15, 16 are yet to happen. Okay, so company somewhere in between here, right? So say for example, this is say February 2014. The financial year 14 has not yet ended. So company is given projections for the next 3 years. So in the process, since this financial year has already begun, right? The financial year 13-14 has already begun. So 12 months have already passed. So company has also given provisional financials as on 31st December, right? Because 9 months have already passed. So till December, the company has given projections, provisional financial statements for the first 9 months, right? So this is the data. So let us look at the data. So as you can see, we have 3 years actuals, 11, 12, 13. We also have the we also have the provisional balance sheet for the first 9 months of this financial year, 13, 14. Okay, first 9 months we have the provisional. So till here is the actuals. Okay, all these are actuals, and then from here is the projections. 14, 15, 16 are the projections. So we got a P&L account, right? Please note that the format is an abridged format. This is not the actual format you see in the same data. Because of the space constraint, we have deleted some rows, but almost all the items are available for you for analysis. Okay, so all the items you see in the P&L account in the operating statement, right, are available. Okay, again 3 years actuals and performance to the first 9 months of this year. All these are actuals. And from here we have the 3 years projections, 14, 15, 16. So these are the liabilities, assets. Again, abridged version, right? All the empty rows, blank rows. Say for example, advance from customers. So this company doesn't have any advance from customers. All of them is nil. So we have deleted those rows. Okay. So all those blank rows are deleted. So none of that would matter. Okay. This is all the. So all the relevant entries for this company are furnished here. So based on this CMA data, there is a P&L account in the balance sheet. Let us try to answer some of the questions, right? So the first question, let us see the first question. Net profit declined in 2012-13 as against previous year. So compared to 2012, it looks like the net profit has decreased. So should you be concerned as management of this company? If you are the management of this company, should you be concerned? So let us go back and see this P&L account. 2012 net profit and 2013 net profit. Okay, let us see the net profit figure. So 2012 the net profit is 4.95 crores, right? And for 13 it is 4.88 crores. So there is a decline in profit. Not much. It is not a huge decrease, but it is a decrease. Right? So should you be worried as a management? Well, there are two answers to this. Okay. That's why it's very important. I told you earlier, you should never go by absolute figures. Absolute figures can be misleading, right? So you always calculate in percentages, right? That will give you a correct picture. So profit after tax, even though it has decreased in absolute terms, look at the turnover. This 4.95 crores of profit is for a turnover of 289 crores, right? Whereas this 4.88 crores is for a turnover of just 236 crores. So actually we are seeing here that turnover has decreased, right? The profit has also decreased, but if we actually calculate the percentage, right? Shall we go ahead and calculate the percentage? So you will get 1.71 and 2.06%. Okay, if you do the calculation, 4.95 by turnover 289.4. So this will be the profit percentage, profit margin. This is 1.71%, right? Similarly, calculate for 2013, 4.88 is the profit divided by turnover of 3658. Right, so you are getting a profit figure of 1.71 and 2.06 percentage. Okay, so as the management of this company, purely from the point of view of net profit, you need not be worried. Yes, the profit has declined, but in terms of profit margin, the margin has increased. This has decreased only because the turnover has decreased. So if there is a problem, as a management, you should be more concerned about the turnover, right? Turnover has decreased. Why it has decreased? You have to investigate, right? But as far as profit is concerned, the profitability, the profit margin has not decreased. In fact, it has increased, right? And is almost at the same level, right? 4.95 or 4.88, in spite of the turnover decreasing by almost 45 crores. Is it 55 crores, right? 55 crores over 289 something. So you are getting around close to 20%. See, even though the turnover has decreased by close to 20%, in spite of that, the profit was almost at the same level. So the profit was not a problem. So as a management, you need not be worried about the net profit so much, right? There is one more point you need to take care of here. If the turnover has increased, say this is 289, close to 290, and this is 300 crores, okay, and the profit has decreased, you should also see where this has decreased. This we have discussed, right? So profit happens at various levels, right? It happens at the gross profit level, operating profit level, EBITDA, EBITDA, right? EBITDA, and then we have the PBT, PAT. So there are various levels of profit. So look at this company. The profit has decreased, but why has it decreased? At what level it has decreased? So if you look at the operating profit, right? The operating profit in fact has increased compared to previous year. It was 4.19 crores last year, and this was 4.87 crores. So actually, so say for example, this is a turnover of 290 crores and this is 300 crores. Let us assume that. So till this point, the turnover has increased, the profit has also increased. So now why this turnover has decreased in the final leg is because of a non-operating income. See, 0.89 crores. So last year it looks as if there is a non-operating income of 89 lakhs, which has boosted the profit of the company. Right? If you take out this figure, right? If you take out this figure, you would have found that profit of 13 would have been more than profit of 12. So because of this non-operating income, last year it looks like the company has got a higher income. And by comparing this year's profit with last year's profit, which included this non-operating income, is not a proper comparison, because this year the company didn't have non-operating income. So if you want to compare, you have to compare at this level, right? At the operating profit level, right? Then it looks like the company has done well, right? From the profit point of view, right? From the profit point of view, it looks like the company has done all right. Turnover, yes, the turnover has decreased. So it is something that as a management, you need to be worried about, right? Let us look at the second question. So calculate current ratio as on 31/3/2013. If the bank norm is 1.33, does the company's current ratio satisfy this norm? So let us calculate the current ratio. Current ratio, you need to go to the balance sheet. Let us see the current ratio as on 31/3/2013. So you know current ratio is current assets by current liabilities, right? So what is the current assets as on 13? So you have various assets here, right? Up to here is the current assets, okay? You can see this cash, receivables, finished goods, right? All this. So we have also given the total of current assets. So to make a job easy, so 91.54 is the total current assets, right? Rest of all are not current assets. Your fixed assets, your non-current assets, right? All these are non-current. So up to here. So a 91.54 is your current asset. What is the current liabilities? So proprietors capital, unsecured loans, other time liabilities, total time liabilities. Up to here is the term liabilities, right? From here it is all the current liabilities. So total current liabilities, you are given the total as 74.05. So 74.05. So if you do the calculation, you will be getting a current ratio of 1.24. So as on 31/3/2013, right, the current ratio of the company is 1.24. So we are given that the bank norm is 1.33. The current ratio as on 31/3/2013 is not as per the bank's benchmark norm on current ratio, right? So it is less than 1.33. Okay, so that is the inference. So it is low. So let us take this forward. Let us spend some time on the current ratio. Let us go to the next question. So how does the company, the third question. So second question is calculate the current ratio is 1.24. If the bank norm is 1.33, does the current ratio satisfy this norm? It doesn't satisfy. Okay. So third question is, how does the company propose to improve current ratio by 31/3/2014 compared to 31/3/2013? Okay. So it looks like this company has come for enhancement of working capital limit. So if you look at the working capital limit, that's short-term borrowing, you can see that as on 31/3/2014, the company is projecting around 30 crores. Okay. So the current limit looks like it's around 20 crores, right? It's around 20 crores. So it looks like now the company has come for enhancement of working capital limit from 20 crores to 30 crores. Okay, but the current ratio is less than the bank's norm. So what should a bank do? Right, usually this is not a great position to be in. As a banker, you should not be really taking up this proposal unless you're convinced that the current ratio position will be improved. So actually, if you calculate let us do one thing. Let us do the calculation for the projected current ratio. So for 2014, let us calculate the current ratio, current assets by current liability. So what is the current assets? So it's 93.12. And what is the current liability projected for the next year, 31/3/2014? It is 45.48. And immediately you can see it's more than 2. Right? 45 into 2 is 90. So definitely you are looking at the current ratio of more than 2. If you want to actually particular about the absolute value, it is 2.05. So last year, as on 31/3/2013, the current ratio is just 1.24, whereas now the company is projecting a current ratio of 2.05. Immediately, as a banker to this company, your eyebrow should be raised. This company, how is it going to improve the current ratio? In fact, we had a discussion on this. So whenever company has got a lower current ratio and is trying to project a favorable current ratio, you have to see how it is going to improve. Don't be satisfied that the projected current ratio is greater than 1.33 and hence we are fine. Okay, that's not the case, right? You'll always, when this is a sort of scenario when the current ratio is less than the bank norm, definitely the company will prepare a projections in such a way that the projected current ratio will be greater than 1.33, because otherwise bank will object, right? So definitely the projections will be prepared in such a way. So now your job as a credit officer, be convinced that the company can actually improve the current ratio from 1.24 to 2.05. So how is the company planning to improve, right? So this is apparent from the if you look at for that, if you recall, we've done something called funds flow statement. Okay, we had a discussion on diversion of funds, right? There we discussed about the concept of funds flow statement. Basically, how you have to see between 31/3/2014. Between this and this, for this one full year, right, that is during the financial year 13/14, which 14/14, what is the long-term surplus? Okay, what is the long-term surplus? So the projection will be such that even without doing the calculations, you can straight away tell that because the current ratio is improving, because NWC, the projected NWC is increasing, what the company is basically saying is we are going to have some long-term surplus during this year. So whatever is that long-term surplus, we don't know. Let us not focus on the quantity right now, right? But we can for sure tell that what the company is telling is by 2014, during this year 2014, we are going to have some long-term surplus of some quantity, say some X crores, okay, right? This will boost our NWC. So if NWC as on 2013 is something, right, say A, by next year our NWC will increase to last year's NWC plus this long-term surplus, right? This is what the company is saying. Let us calculate what is the NWC straight away. For 2013, what is the NWC? Current assets minus current liabilities. Absolute figure, not current ratio. Okay. So current assets is 91.54 minus your current liabilities is 74.05. Do the calculation. You're getting 17.49. Okay. For 2014, let us do the same calculation. What is the projected NWC? Current assets is 93.12 minus 45.48. Again, do the calculation. So this is what we got. NWC as on last year 2013 is 17.49 crores, whereas the projected NWC, the company is projecting at NWC of 47.64 crores. So the company is saying the NWC during this year will increase by whatever is the difference. Okay, this looks like around 30.15. Okay, 30.15 crores. The company. So this is how the current ratio is going to improve. If you calculate the current ratio, it is 1.24. Right, this is 2.05. So the company is saying we'll improve the current ratio from 1.24 to 2.05. So whenever, if you want to investigate how the company is proposing to improve the current ratio from so and so to so and so, first you have to calculate the NWC, right? So speak in terms of NWC, not current ratio. Okay. So and this is current assets by current liabilities. Okay, that is current ratio. So now let us speak in terms of current assets minus current liabilities, which is nothing but NWC. Okay. So let us speak in terms of rupee terms. So NWC last year was 17.49 crores. Now the company is projecting the NWC to improve to 47.64 crores. Thereby the increase in NWC the company is projecting during this single year 2013-14 is 30.15 crores. Let us remember this figure, 30.15 crores. The company is planning to improve NWC by so and so amount. How is the company going to improve this NWC? So what company is basically saying is we are going to have some long-term surplus in this year. What is long-term surplus? We are going to get some funds, long-term funds, some funds, so and so. We are going to have some long-term uses, so and so. This will be more than this by 30.15 crores. For example, if this is 40.15 crores, we'll be having long-term uses of only 10 crores. Thereby the surplus of 30.15 crores will be going towards the short-term deficit, which is nothing towards the improvement in NWC. Now this might sound complicated, as already discussed in the chapter on working capital assessment. Funds flows, concepts like current ratio, NWC, funds flow statement are complicated concepts. So don't worry too much if you don't get the concept right now. Right, it will take time to sink in. For the moment, just try to go through this question. Okay, so even if you are not able to solve, or even if you are unable to follow, it's okay. You can revisit it at a later time. It will get in ultimately, right? So basically, try to see what I'm doing. So the company is saying we are projecting. The company is saying this year will be having a long-term surplus of 30.15 crores. How? The company is saying we'll have a long-term sources something, not 40.15, something. If this is 40.15, it is saying we'll have just a sources uses of 10 crores. Thereby we'll having a surplus of 30.15 crores. So let us try to calculate this long-term sources and long-term uses. Okay. So let's try to do that. So 30.15 is the increase in NWC projected by the company. Okay, let's keep this figure aside. Remember this figure, 30.15. Now let us calculate what is the long-term sources of funds for this company in 2013-14. Okay, so long-term sources is any funds which are in long-term in nature, which the company is proposing to raise. Okay, so 42.57 is the capital last year. Okay, closing capital for previous year is 18.66. So this is the increase in capital the company is proposing. But yeah, you should remember that in a company setup, right, capital and reserves and surplus are shown separately. But whereas in a proprietorship setup and partnership accounts, we are going to club the capital and reserves and surplus and show as a single partners account or proprietorship account. So what you basically need to do is you go back to the profit. So 2014 the projected profit is 5.09 crores. Okay, so let us do like this. So the capital last year was 18.66 crores. Next year the company is projecting 42.57 capital. So the difference is nothing but the additional capital the promoters are proposing to bring in. Okay, the proprietor is proposing to pump in. Okay, so 23.99 crores the proprietor is proposing to bring in as fresh capital. Of course, this includes profit for the year, that 5.06 something, right? This includes, so balance 18 point something will be the fresh capital the proprietor is proposing to improve, because in a company setup we are going to show the capital and reserves and surplus separately, but whereas for partnership and proprietorship accounts we are going to club that into a single capital account. Okay, so this 42.57 the projected capital next year and actual capital for this year, the difference is nothing but the increase in capital. Out of this there is a profit earned for this year 5.06, right? So 23.91, 5.06 is the profit for this year, and the balance 18.85 is the fresh capital the proprietor is going to pump in, right? So 23.91, let us keep this figure aside. 23.91 is the one of the long-term sources of fund. Any other long-term funds the company is proposing to infuse. So 17.86 is not changing, that is unsecured loans as it is. Then there is something called other term liabilities. It is 7.61 next year, 1.67 this year. So try to calculate, you are going to get a 5.94. So this is another source of long-term fund. Okay, 29.85 is the total long-term sources of funds. That's it, because from then on you're going to have the short-term that's the current liabilities. So long-term sources are only these two. Okay, what is the long-term uses? So all these are current assets, so we are not worried about that. Let us see the long-term uses. Long-term uses comes from here, 0.27 as it is. There is something called deposits, 1.58 and 0.63. Okay, so what is this? 0.95. The difference is 0.95. Look at this depreciation figure, it's 1.25, isn't it? So 19.8 minus 18.55. So that is a 1.25. So that 1.25 can add back to source of fund because depreciation is a non-cash expense. Okay. So yeah, add back, you're going to get 30 point. This is 30.15. 30 point. So this is 30.1. Okay. So around that 30.15 which you got earlier. What is the 30.15? If you remember, that is the change in NWC. NWC of 14 minus NWC of 13 we calculate as 30.15. So it is getting around here, right? So basically this is how the company is planning to improve the current ratio. Last year the current ratio was 1.24. The company is projecting a current ratio of 2.05 for 31/3/2014. How the company is going to improve this NWC? So NWC is going to be improved by, the company is saying we are going to bring in fresh capital. The proprietor is going to pump in additional capital close to around 18 crores. Then he's got around 5 crores of retained profit. So put together the 23 crores. Then there is some other term liability, that's around 6 crores. So around basically these two are the major sources, right? So that's how the company is saying we are going to improve the NWC. Now you have to question whether the proprietor is capable of really pumping 18 crores of fresh capital, right? Whether he is really sound enough, can he do that, right? What are the other term liabilities of 5 crores which they are projecting? 5 to 6 crores. What is the other? What are the sources? So are these going to materialize? Because basically only on this assumption the company is saying our current ratio is going to improve. So you have to critically question these two. Whether the company, whether the proprietor can bring in this 18 crores, when he is going to bring in. Actually, if you look at the provisional balance sheet as on December, right, it has already increased, right? So it's like that. It's like the proprietor has already pumped in funds, but please always make the point that don't rely on provisional balance sheets. Provisional balance sheets are unaudited balance sheets, and there will be cases where the final audited balance sheet and provisional balance sheet differ vastly, right? So never rely on a provisional balance sheet. But if you had to rely on this figure, you have to get a chartered account certificate confirming that the proprietor has infused funds, right? But please don't go by provisional balance sheet as it is, okay? But basically this is the plan of the company, how to improve the current ratio, right? Next question is calculate interest coverage ratio as on 2013. Okay, interest coverage ratio. So interest coverage ratio, we know the formula, it is profit before interest and tax by interest expenditure. So let us calculate this. So PBIT, how you are going to get PBIT? Profit before interest and tax by interest. Okay, so profit before interest tax is nothing but profit before tax, you add back the interest portion. So there you will get profit before interest and tax. This is profit before tax. We don't want just profit before tax, but also profit before interest and tax. So add back the interest portion divided by the interest. Okay. So what is PBT? So for 13 PBT of 4.88 crores. Add back the interest component 3.03 by interest 3.03. Right? Whatever it is, you can do the calculation. 7.99 by 3.03. So around 2.5 is it? Around 2.5, greater than 2.5. That is, so benchmark usually interest coverage ratio 2 is satisfactory. So this is okay, right? This is satisfactory. So let us see the next question. The company has applied for an enhancement in working capital limit. From the angle of turnover, what would be your first question to the company? From the angle of turnover. So this company has applied for turnover. We've already seen that its existing limit is 20 crores. It is now applied to 30 crores enhancement. So there are various questions you will ask this company, right, regarding enhancement. But from the angle of turnover, right, what is the primary question you are going to ask? So if you look back at the P&L account, you will observe one thing. The company is projecting a turnover of only 200 crores for 14, whereas the existing turnover is last year is 236. Right? If you look at the last 3 years turnover, it is more than the minimum turnover is 235 for this year. Okay, so the company was able to manage with limit of 20 crores. Company was able to achieve turnover of 239, 239, 260, 280 with a working capital limit of just 20 crores. But now the company is saying for just achieving 200 crores, it's not even 236 last year. For just achieving 200 crores turnover, we want 30 crores. So this is something normally increased working capital limit, enhanced working capital limit is required for increased business, right? So basically, company is saying our business is improving, so that's why we need to require additional working capital. But in this case, the company is saying we're not going to reach that much turnover as in the past, but still we want enhancement. So your first question as a banker to this company would be, why do you require additional enhancement? Right? When your turnover is not as per the previous year, when it is declining, why do you require a more higher limit? So naturally the company should be able to manage with a lower limit if the turnover is lower than last year. But now the company is saying we need a higher limit. So that will be a first question. Right? Normally companies will always project a higher turnover. Right? Usually company will always project a higher turnover because this is a question which bankers will ask.
if they don't do, this is a question bankers will ask, why you need enhancement when you are targeting a lower turnover. Okay, but this case it looks like that, like the December position is already available, right? If you look at this, the December position is already out. Maybe this proposal submitted somewhere in Jan 14 or February 14, right? By which time the bank has a fair idea of the turnover of the company. So every month the company is submitting MSODs from April 2013. So till December 2013, the bank has got the MSODs, right? So the turnover is around 148 crores. So based on this, the bank will be having right. So just because the company says we are going to reach a turnover of say 250 crores, it's not that easy, right? Because there's just 3 months left, and now the company has to achieve more than 100 crores. So the company also knows that the bank is not going to accept blindly these projections. So the company has projected around 200 crores, which is likely it's going to achieve. This is likely to achieve. Okay, the company has already achieved 150 crores for the 9 months. So for the full year, it's likely to achieve around 200 crores. So the projection was reasonable. Why the company couldn't project more than 200 crores? Because already it is December, and now the company cannot fool the bank by saying in these 3 months we'll achieve 100 crores turnover, right? So that the company can't do. Because of that reason, it has targeted a turnover of only 200 crores for next year. So as a banker, your first question should be, if this is the scenario, why do you require an enhancement? Why do you require enhancement in working capital limit, right? Right. So that is the answer to this question. We'll follow up this question further, right? So that is the answer to this question. From angle of turnover, why do you require enhancement when your turnover is at a lower level than the past, right? Let us take this further. Analyze the projected holding levels for the inventory, debtors and creditors, right? Analyze the projected holding levels for inventory, debtors and creditors. Do you get the feeling that the assumed holding levels are set in such a way so as to get eligibility for the enhanced limit? So what the question basically is asking is, for the level of operations of this company, the company is presently operating at a turnover of around say 200 crores. Maybe for this turnover the company requires just around 15 crores or 20 crores. Let us say this is reasonable, right? As a banker, you know this, right? Based on the competitors and based on past data, you feel that for a turnover of, because this is the turnover the company is going to likely to achieve for 13-14. Okay, for the present, for this level of operations, a limit of 15 to 20 crores is reasonable for this firm, right? But now the company is applying for 30 crores. Okay, company is applying for 30 crores. So how did the company actually get this eligibility? Because in the projections there's something called MBBF, right? So how did the company get this eligibility? So the question is asking, as the company, do you get the feeling, do you suspect as a banker that the company has manipulated these holding levels in such a way so as to get this eligibility? So let us see that. Okay, so this projection of 30 crores is just not like that. It's not out of thin air. Okay, there is some basis to this. You will see that in projections, how the company has projected, what item it has projected, it will increase or it will decrease. So what are the figures it has manipulated? You have to see this as a banker. Okay, so what are the figures the company has twisted in the projection so as to get this eligibility of 30 crores? So let us see this. Let's go to the projections. For answering this question, you need to first of all calculate the holding levels, because unless we calculate the holding levels, we are not going to have a present picture, right? I'm not going to do the calculation, right? You can work this out. I'm going to give you the results, right? This is what the holding levels are. Okay, so if you do the calculations for holding levels, this is what you're going to get, right? You can do this calculation, right? So how you calculate this inventory holding level? Inventory holding level is nothing but, for this company, it has got only finished goods holding level. Okay, so there's no raw material, it's only finished goods. This is a trading company. Okay, this is a company that's engaged in trading, so it's not into processing, so there will be no stock of raw material and work in progress, entirely finished goods. So the finished goods holding level for this company is so and so. So how are you going to calculate this? So inventory holding level will be, we know this, right? So you find out what is the closing stock of finished goods as on 31. Say for example you want to calculate as on 13. So take the closing stock of finished goods, right, into 12 divided by cost of sales. We discussed this. Okay, similarly you want debtors, take the closing debtors, whatever is the debtors figure, into 12 by sales. Okay, creditors, closing creditors into 12 by purchases. This is the consumption, raw material consumption. Okay, so whatever this is how you're going to do. So if you happen to do that, you're going to end up with these figures. So inventory, debtors, creditors, these are the major items, because there is no raw material and finished goods, so entire inventory is finished goods. There is no raw material work in progress, so entire inventory is finished goods, debtors. So these two are the current assets. This is the major current liability. Okay, so look at this. As a banker, you know the background, right? The company he is availing a limit of 20 crores. He is now applying for 30 crores enhancement. Looks like the company is not doing too well. The turnover has decreased compared to last year. Now, but the company is requesting for an enhanced limit. So basically the company, the auditor is going to fudge the figures somewhere, the projections somewhere they're going to do the setting to avail that to get the eligibility for the enhanced 30 crores limit. So let us see what basically the company is trying to do here, right? What the company is saying is we need to maintain stock of around 4 to 4.5 months. This might seem high, but because the company is in a trading business, and also because the last year actuals as on 31/3 is close as on 31/3/2013 is around 4 months. This is all right, right? So you get the feeling that this company is maintaining this stock due to various reasons. We need not get into those reasons, but because the past figures suggest the company is maintaining this sort of a inventory, the projected level is more or less in that range. So okay, we can accept this. What about debtors? The company is projecting a debtors of 1.4 to 1.75 months. If you look at it in terms of days, it will be around 40 days, right? 1.4 into 30, right? That will have 42 days, and this is 1.75 into 30, around 55 days. Okay, so around 40 to 50 days the company is trying to project. So actually the debtors period as on 31/3/2030 is only 0.85 months. That is less than 30 days, right? This is less than 1 month. So now the company is saying, so due to this our business was affected because we extended low credit to our customers. We could not get that much turnover. Now we are going to offer more credit to our customers, right, to match our competitors. So thereby we are going to get more business. So that seems to be a reasonable logic, because if you recall 2012 the company has got was extending debtor period of 1.33 months. So it looks like the company has reduced the credit period due to some cash mismatch. We don't know, whatever might be the reason. So the projected debtor period looks to be okay, right? Even though last year's 31/3/2013 was lower, the company is giving a justification, right? Because it was lower, we are not able to get business. Now we are going to increase the debtor period to 40 to 50 days, so that we are going to match our competitors and we are going to get back good business. So okay, acceptable, right? But look at this creditors. Actually, there's a 2011 figure is also available. If you look at it, it's also around, it's greater than 2 months. Okay, so for the last 3 years, the company is having a creditor period of 2 to 3 months. So it looks like this company is able to avail market credit. Okay, the creditors is high; it's around 2 to 3 months. But now the company is projecting creditors of only 1 month. Right? This is what you have to question. Because had this creditors period been projected at 2 to 3 months, as was the case in the past 3 years, the company would not have gotten eligibility of 30 crores. The turnover, the eligibility would have been less. Right? This is what you have to question. It is because of this adjustment the company has got the eligibility of 30 crores, and we are going to do the calculation right now. Right? Shortly we are going to do the calculation. But the point you have to remember is the company auditors have adjusted this figure. We are not going to get that much credit. We are going to get only creditors going to give only credit period of 1 month. Raw material supplies. Right? We are going to give a credit of only 1 month. Right? Because of that. But whereas we have to give credit of more than 1 month to our customers, debtors. So based on that, we are going to require additional limit. Now you have to question as a banker: is the company really? Is it really true? Right? Why is the creditor suddenly going to reduce the credit period? That's not going to happen. Right? If it is happening, that is a different issue. Again, that is a problem. Was the company not doing well? Was it payments to the creditors not up to the mark? Why are they reducing the credit period? So that is another problem. But it looks like in this case the company is just projecting a lower creditor period in order to get the eligibility for this proposed enhancement, right? So from the point of view the holding levels, it looks like the inventory and debtors are all right. We can accept the projected holding levels, but whereas the creditors is something we need to question. It can't be at such a low level, because if you look at the last 3 years, it is around 2 to 3 months. And if you make some independent inquiries with the people operating in this industry, you'll be having a lot of accounts, right, in your bank. So let us say this is a trader in some particular activity. You'll be knowing other customers who are engaging in similar activity. So you just talk to them, over the phone, just call them. You'll get an idea that the market rate in this industry is around 2 to 3 months. You'll get that idea, right? The past data can't fool you. It's around 2 to 3 months. The competitors will not fool you. They are saying the market credit availability is around 2 to 3 months. We all are getting that credit, right? So basically this company is projecting a lower creditors in order to get the more eligibility. Okay, so this is something you have to question. Okay, So the next question is, what is the working cap? So analyze. So this question, answer to this question is, analyze the projected holding levels for inventory, data, and creditors. So these two are okay. These are not okay. Do you get the feeling that the assumed holding levels are set in such a way that to get eligibility for the enhanced limit? Yes. It looks like the creditors figure was deliberately projected at lower level in order to get the eligibility. Okay. So next question is, what is the working capital gap estimated as on 31/3/2014? So let us see what is the working capital gap estimated as on 31/3/2014. So let us not stop at working capital gap. We'll proceed further and also calculate MBBF. Okay. Again, MBBF is something which is automatically calculated by the Excel sheets which is provided to you by your bank. Okay. But in spite of that, we'll do the manual calculation. Let us see the concepts. Okay. So we'll calculate the MBBF, and in the process we also calculate the working capital gap. That is the answer to this question. Okay. So let us see for 31/3/2014 what is the working capital gap. So let us first of all calculate the current assets. Okay. So total current assets is your inventory. So inventory is 69.69. Okay. Then you have debtors. Debtors is 23.33. Then there's some other current assets, some 0.1. So put together you're going to get a total current assets of 93.12. Okay, this is your current assets. So from this we are going to decrease all current liabilities except the bank borrowings. Okay. So leave that 30 crores projected bank borrowing. Except that, what are the other current liabilities? So creditors is 14.83. There's some current liabilities, other current liabilities. So put together this is 15.48. Okay. So this minus this is going to give us what is known as the working capital gap. Current assets minus current liabilities except bank borrowings is the working capital gap. So that works out to 77.64. Okay, 77.64. Okay. So what is this 77.64? So there is a total current assets. Current assets will be financed by a bank OCC. Your creditors will finance, and your long-term sources funds. Right. This is NWC. This includes the borrower's margin. Okay. So let us not say just borrower's margin. This is a total long-term funds. Okay. Surplus of long-term funds. Okay. This is the long-term funds. There's a portion of current assets that is being financed by the long-term sources. Okay. So this is NWC. So we got this current assets total as 93.12. So this 93.12 is being financed by various parties. What we do as a banker, we calculate what is this, and then whatever is the balance, we finance. Okay. So what is the creditors? So it's not just creditors. Let us also explain to creditors and other current liabilities, whatever it is. All current liabilities except bank borrowings. Okay. So this we calculated as 15.48. Just now we calculated. This is 15.48. Okay. So total current assets 93.12. Out of this, 15.48 is the creditors. All current liabilities other than bank borrowings. So this difference, this 93.12 minus 15.48 is what we got as working capital gap. Right. Who should finance this balance? Only these two, CC and NWC. Okay. So we find out what is this, and balance as a bank will finance. Okay. Is this clear? Current assets is always financed by only three parties. One is the bank borrowing, other is the all current liabilities except bank borrowing, because this is a bank borrowing. Okay. These two put together is nothing but the current liability, isn't it? These two put together is the current liabilities. We are breaking the current liabilities into bank portion and non-bank portion. Non-bank portion means take entire current liabilities from the subtract the bank portion. Bank portion you show separately. So these two put together is nothing but the current liabilities. So current assets are being financed by current liabilities and NWC. That is the formula, isn't it? What is NWC? Current assets minus current liabilities. Or in other words, current assets is current liabilities plus NWC. Your current assets of a company are financed by current liabilities and NWC. That is what you are getting here, right? Current assets are financed by current liabilities, these two put together, and NWC, right? What is the NWC? So here there are two things you have to do. One, you have to calculate what is the minimum NWC. So let us assume for this company, this is a small company. Let us say 13% of current assets is the minimum NWC. Okay, right? Minimum. So 93.12 into 13%. So that you are going to get around 12.11. Right? And then you also calculate what is the actual NWC. What is the actual NWC the company is projecting? It is projecting 47.64. So what you have to do is, actually the bank eligibility will be, okay, the bank eligibility will be out of 93.12, these people, the creditors people are financing 15.48. Okay, NWC is 12.11. Okay, because this is the 13% minimum NWC, right? And the balance bank will finance. Right? The balance bank will finance. But if you do this, you will be ending up over financing the company, because the actual NWC is greater than the minimum NWC. So this is a point which we discussed earlier, right? So if the actual NWC is greater than the minimum NWC, you have to take only the actual NWC, because otherwise you will be ending up over financing the company. So let us not take the the minimum NWC. Let us take the actual NWC, the projected NWC, that is 47.64. So now we can solve the question, right? So the total current assets of 93.12 are being financed by one, your creditors and other current liabilities 15 crores, 15.48 crores, NWC 47.64 crores. So the balance, whatever it is, bank will finance. Okay, so you add up these two, you're going to get 48, I think 63.12, is it? 63.12. Okay, so 93.12 minus 63.12, 30 crores bank OCC. So this is a breakup, right? So what is the MPBF? 30 crores is the MPBF. So this is how we obtain. What is the working capital gap? The answer to this question is 93.12 minus 15.48, 17.64. That working capital gap is going to be financed by OCC of 30 crores and actual NWC of 47.64 crores. Okay. Let us see the last question. What is the change in NWC estimated between 14 and 15? Is this figure the same as long-term surplus of 14-15 in funds flow statement? All right. Again, if you recall, we did this for 2014 and 13. Didn't we do this? We calculated NWC as on 13. We calculated NWC as on 14. I think this difference we got 30.15 crores. And then we do the funds flow statement. We calculate the long-term surplus. We calculated the long-term uses. And for this, I think we got 0.95 something. Here we got some 29 something, whatever. So this difference, long-term surplus, you got again the same figure, 30.15, right? So based on similar lines, you can calculate this for the next year. Okay, you please take this as an exercise. You can do this. Right? Basically, what you have to do is calculate NWC as on 14. How you are going to calculate? Current assets for 14 minus current liabilities for 14. This is directly available from the table. The total of current assets is given. Right, so calculate the difference between current assets and current liabilities. That will be the NWC for 14. Also calculate the NWC for 2015. Current assets minus current liabilities. 15. Right. So this difference will be whatever is the change in NWC. You keep that figure. Say for example is some X crores. Then you calculate the long-term surplus. What is the long-term surplus? Long-term sources. Just like we calculated for 2014 versus 2013. Okay. Minus long-term uses. So long-term sources will be increase in share capital. Right, increase in unsecured loans, increase in other term liabilities. Okay, your long-term uses will be increase in fixed assets if any, right? Increase in non-current assets, right? Those sort of things. Okay, so that difference will again you'll end up having it X. These two will be same. Okay, you can do this calculation just as we did for the 2013 versus 2014 versus 2013. Okay, so with that we come to the end of this segment, right? So in the coming chapters we'll be taking a couple of case studies. To deal with a variety of scenarios. We'll be discussing how to tackle a proposal on term loan, how to tackle a proposal of working capital enhancement. What are the points you need to look for when you get a proposal, right? How to start a proposal from scratch, right? We're going to take a couple of case studies, right? So see you then.